On January 30th, 2026, JPMorgan Securities closed 633 silver short contracts at the exact mathematical bottom of a market crash that erased $7 trillion in a single day. Not near the bottom, at the bottom. Then, immediately, prices began recovering. This isn't speculation. This is documented COMEX data. And what I'm about to show you is proof that what happened wasn't a market correction. It was a controlled detonation, mathematical certainty, not opinion, pattern recognition. Silver collapsed 31% in one trading session. The largest single-day loss in recorded history, not the worst in a decade, not the worst since the 2008 crisis, the worst ever recorded. Gold fell 11%, wiping out $5 trillion. Silver's crash erased $2 trillion. Platinum sank 20%. Palladium plunged 16%. $7 trillion vaporized while you were checking your phone, drinking coffee, living your normal Friday. And buried in the COMEX report, dated January 30th, is the smoking gun that proves every second of this was orchestrated. JPMorgan closed 653 silver shorts at the exact bottom. Then the price started climbing back. You can't unsee it once you see it. This is the financial equivalent of watching someone yell fire in a crowded theater. Wait for everyone to stampede toward the exits, then calmly walk to the front row and sit down. They didn't predict the bottom. They created the bottom. Same pattern, same sequence, same outcome. Let me show you what mathematical certainty looks like. On January 30th, COMEX silver traded roughly 368,561 futures contracts. Add in 28,152 options contracts. Each COMEX silver contract represents 5,000 ounces of physical metal. Do the math. That's approximately 396,700 contracts total. Multiply that by 5,000 ounces per contract. You get 1.98 billion ounces of silver traded in a single day. Let me repeat that number because it's the key to understanding everything. 1.98 billion ounces. Nearly 2 billion ounces of silver changed hands on paper in one trading session. Now here's the problem. Global annual mine production of silver is between 800 and 850 million ounces. They traded more than twice the entire world's annual silver production in one day. Not 1 month, not 1 quarter. 1 day. This wasn't price discovery. This was a paper avalanche designed to create the illusion of infinite supply in a market where physical supply is vanishing. While this paper tsunami was crashing through exchanges, physical dealers were suspending trading. Delivery times jumped to 8 to 16 weeks. Inventories disappeared. Premiums detached from reality. The paper market says abundance. The physical market screams scarcity. You can't unsee it. Here's where it gets darker. While COMEX closed at $84 per ounce after the crash, Shanghai spot silver was trading at $122. That's a $37 premium. After the largest single-day collapse in history, Chinese buyers were paying 44% more than New York paper traders. Read that again. The premium didn't compress, it didn't disappear, it widened. In every normal market crash, physical premiums evaporate. Panicked holders flood the market with metal. Buyers disappear, premiums go negative, but not this time. After a 31% bloodbath, the Shanghai premium held at 44% above COMEX. That's not a broken bull market. That's a paper market losing all credibility while the physical world operates in a completely different reality. And 2,514 silver contracts for February 2026 have been issued delivery notices. Real people demanding real metal, not synthetic paper promises. Physical bars they can hold. This is the unresolved tension at the heart of the entire system. The paper market traded 1.98 billion ounces while physical buyers wait months for delivery and pay 44% premiums. One of these markets is telling the truth. The other is a controlled fiction. And JPMorgan's 633 short contracts closed at the exact bottom tell you which is which. Let me take you back through history because this pattern has happened before. 3 times in the last 2,000 years, empires have followed the exact same sequence. Overextension, currency debasement, loss of trust, collapse. It's not a theory. It's a documented cycle. Same pattern, same sequence, same outcome. The Roman Empire, 3rd century AD. Rome controlled the known world. Unstoppable legions. Engineering marvels. Trade routes spanning continents. Then they started debasing their currency. The denarius, once nearly pure silver, was diluted with base metals to pay for endless wars and bureaucratic expansion. By 270 AD, the silver content had dropped to less than 5%. Inflation exploded. Trade collapsed. Legions went unpaid. Borders crumbled. Within decades, the Western Roman Empire ceased to exist. Verified. The Dutch Empire, 17th century. The Dutch Golden Age. Amsterdam was the financial center of the world. The Dutch East India Company was the most powerful corporation in history. The guilder was the global reserve currency. Then came the wars, the Anglo-Dutch Wars, the War of Spanish Succession, endless military spending, Debt spiraled. The cost of maintaining empire exceeded the wealth it generated. By the mid-1700s, Britain had displaced the Netherlands as the dominant financial power. The guilder faded into irrelevance. The empire that once ruled the seas became a footnote. Check. The British Empire. The sun never set on British soil. The pound sterling was backed by gold and enforced by the Royal Navy. Global trade denominated in pounds. Then came 2 world wars. Britain borrowed massively to survive. The cost was unsustainable. By 1944, at Bretton Woods, the United States took the mantle. The dollar, backed by gold, became the new global reserve currency. By 1971, even that gold backing was gone. Britain's empire dissolved. The pound became a secondary currency. The cycle turned again, verified. 3 empires, 3 collapses, same pattern. Currency debasement, uncontrollable debt, loss of reserve status, collapse. Not might happen, will happen. And now we arrive at the present, the United States, the final act of the same play. U.S. national debt is over $36 trillion. It increases by $1 trillion approximately every 100 days. Debt to GDP ratio has exceeded 120%. Interest payments on the debt now consume over $1 trillion annually. That's more than the defense budget. The Federal Reserve has printed trillions since 2008. Quantitative easing, emergency liquidity, bailouts. The dollar's purchasing power has been obliterated. What cost $1 in 2000 now costs over $2. The debasement isn't hidden anymore. It's policy. January 2026. The U.S. government teetered on the edge of a shutdown. The Senate passed a last-minute bill to avoid it. Metropolitan Capital Bank and Trust in Chicago became the first U.S. bank failure of the year. Closed by Illinois regulators due to unsafe conditions and weak capital. Assets, $261 million. Deposits, $212 million. FDIC fund hit for $19.7 million. Small bank, not systemically important, but it's the first. And polymarket odds of a U.S. bank failure on January 31st had surged to 99%. The market knew. The smart money is leaving. Then the silver crash. Perfect timing. Government on the brink. First bank failure. Liquidity tightening across the system. And suddenly, paper silver gets obliterated. 1.98 billion ounces dumped on the market in hours. Cascading liquidations. Stop losses triggered in waves. Margin calls forcing desperate selling. Weak hands flushed out in a single brutal session. And at the exact bottom, JPMorgan closed 633 short contracts. Mathematical precision. You don't time it that perfectly by luck. You time it that perfectly because you orchestrated every move. Here's what you need to understand about what a collapse looks like for you. Not macro policy, not central bank statements. Your life, you go to the ATM, it says insufficient funds, but your account shows a balance. The bank's liquidity is gone. Withdrawals are frozen. You go to the grocery store. Prices have doubled overnight, not gradually, overnight. Because the currency's credibility evaporated and vendors are scrambling to convert to hard assets before they're left holding worthless paper. You try to pay rent. Your landlord demands payment in something other than dollars, gold, silver, Bitcoin, anything but the paper that's disintegrating in real time. This isn't theoretical. This is what happens when trust breaks. And trust is breaking right now. The COMEX margin requirements were raised immediately after the crash. CME hiked margins on gold and silver futures after prices suffered their biggest slides in decades. Think about that. After a 31% crash, after massive liquidations, after traders have been wiped out, the exchange raises margin requirements. That means anyone still holding futures positions now needs to post more capital or get forced out. That creates follow-on selling pressure. More liquidations, more volatility. It's adding gasoline to a fire. And it tells you the system is stressed, fragile, and desperately trying to contain something that's spiraling beyond control. Let me address the 2 types of people watching this. First, the long-term stackers. You've been accumulating physical gold and silver for years, maybe decades. You have a plan. Your time frame isn't measured in days or weeks. It's measured in years and decades. You see a 31% crash, and you're not panicking. You're calculating how much more you can stack at these prices. For you, nothing fundamental has changed. Mine supply is still constrained. Industrial demand is still roaring. Solar panels, electronics, electric vehicles, medical applications. Silver is being consumed faster than it's being mined. The Shanghai premium proves the physical market hasn't collapsed. It's tighter than ever. You're relaxed because you understand the paper market and the physical market are 2 separate universes now, and you know which one reflects reality. Then there are the short-term traders, especially those using leverage. For you, this has been a massacre. A 31% single-day crash with leverage is a liquidation nightmare. Forced selling doesn't care about your thesis. It doesn't matter if you're right long-term. If you can't meet the margin call today, you're out. Your position is closed at the worst possible price. You're wiped out. And if you were on the wrong side of this move, if you were long silver with high leverage, expecting the rally to continue straight up, you've been destroyed. This is why discipline matters. This is why risk management matters. This is why understanding which game you're playing matters. Because the market doesn't care about your opinions. It cares about your capital. And if you don't protect it, it will be taken from you. But here's why the bearish case for paper doesn't kill the bullish case for physical. JPMorgan closed those 633 shorts at the exact bottom. That's not luck. That's control. They know where the bottom is because they're creating the bottom. They dump massive paper supply onto a leveraged market, trigger cascading liquidations, hit every stop loss, flush out every weak hand, then close their shorts at the low and ride the recovery back up. It's a perfect trade, and it's visible in the data for anyone willing to look. The fundamentals haven't changed. Investment buying of physical bars and coins remains strong. Central banks are still accumulating gold. They bought over 1,000 tons in 2023. They're buying again in 2024, 2025, and now 2026. Russia, China, India, Turkey, Poland. They're converting dollar reserves into gold because they see the same pattern you're seeing now. Silver supply is still constrained. Above-ground inventories are being drained. Industrial demand is still red hot. The energy transition alone requires massive amounts of silver. Every solar panel, every EV, every 5G tower, silver that gets used industrially doesn't come back to the market. It's gone. And mine production grows slowly. New mines take years to develop. Existing mines are depleting. The deficit is real. While paper markets can dump 1.98 billion synthetic ounces in a day, the physical world operates under the laws of scarcity. You can't print silver. You can't conjure it into existence with a keystroke. It has to be mined, refined, transported, stored. And right now, physical buyers are waiting 8 to 16 weeks for delivery while paying 44% premiums in Shanghai. That's not a market in balance. That's a market in crisis. The paper system is on borrowed time. We are not at the cliff. We have already walked off it. The first bank failure of 2026 is confirmed. More will follow. When banks fail, liquidity tightens. Counterparty risk increases, trust erodes. The initial reaction is always risk off. Sell everything. Raise cash. It doesn't matter that gold and silver are supposed to be safe havens. In the very first phase of a crisis, margin calls forced selling of whatever is liquid first. That's what we just saw. Phase 1, liquidation. But phase 2 is different. Phase 2 is when the realization sets in that the system is fragile, that banks are failing, that currency is being debased, that trust is broken. That's when the safe haven bid returns with a vengeance. That's when physical premiums explode. That's when delivery demand surges so hard the paper system can't suppress it anymore. We are in the transition between phase 1 and phase 2 right now. History shows us the pattern. Rome debased the denarius and collapsed. The Dutch spent themselves into irrelevance. Britain lost reserve currency status, and the empire dissolved. Same pattern, same sequence, same outcome. The United States is in the final stage of that exact cycle. Unpayable debt, currency debasement, first bank failures, loss of trust. The smart money isn't waiting for the official announcement. The smart money is moving into hard assets now, while the paper crash has created a temporary discount. This is not a collapse. This is a wealth transfer. Wealth doesn't disappear. It moves. It transfers from those who hold paper promises to those who hold physical reality, from those who trust the system to those who understand the system is breaking, from those who react emotionally to those who recognize the pattern. The Roman senators who converted their debased denarii into land and gold survived. The ones who held paper didn't. The Dutch merchants who moved wealth into tangible assets before the guilder collapsed to preserve their fortunes. The ones who believed the empire would last forever lost everything. The British aristocracy, who converted sterling into hard assets before the pound, lost reserve status, maintained their wealth through the transition. The ones who held paper watched it evaporate. Right now, you're watching the same transfer happen in real time. 7 trillion erased in a day. JPMorgan closing 633 shorts at the exact bottom. 1.98 billion paper ounces traded while physical buyers wait months and pay massive premiums. The first bank failure of the year, confirmed with more coming. Government shutdowns narrowly avoided. Margin hikes after the crash adding pressure. This is what the endgame looks like. This is what happens when a paper system built on infinite leverage meets the immovable reality of finite physical supply. The unresolved question is timing. Does the second wave of selling come? Or does physical reality reassert itself now that the shorts are closed and the weak hands are flushed? And with the first bank failure confirmed, how many more are coming? When does phase 2 begin? When does the flight to safety overwhelm the paper suppression? We're in the window right now. The tension is unbearable. The paper market says one thing. The physical market says the opposite. One of them is lying. JPMorgan's perfectly timed short closing tells you which one. The Friday crash was planned. They timed it perfectly. The comics data proves it. 1.98 billion ounces dumped in one day, more than twice annual global production. Shanghai premiums holding at 44% after the worst crash in history. Delivery times at 8 to 16 weeks. First bank failure of the year, margin hikes after liquidation. Every piece of evidence points to the same conclusion. The paper system is in desperation mode. One final flush before reality breaks through. The physical market is screaming deficit while the paper market pretends abundance. And JPMorgan closed 633 shorts at the exact mathematical bottom. You can't unsee it. This is pattern recognition, not opinion, not hype. Historical precedent plus current data. Rome, the Dutch, Britain. Same cycle, same sequence, same outcome. And now it's our turn. The question isn't whether the transfer happens. The question is whether you position yourself on the right side of it. Gold, silver, land, tangible assets that exist outside the paper system, assets that can't be printed, can't be debased, can't be made worthless by a keystroke. The smart money is already moving. The pattern is already in motion. Mathematical certainty. Not might happen. Will happen. Subscribe if you want to see the next phase as it unfolds. Because this story isn't over. The crash was phase 1. The wealth transfer is phase 2. And what comes after that will reshape everything you thought you knew about money, power, and survival in a collapsing empire. This is not the end. This is the beginning of the greatest financial reset in modern history. And you just watched the proof that it's being orchestrated from the top down. JPMorgan closed 633 shorts at the exact bottom. The crash was planned, and now you know.